Welcome. Good morning, everyone. Today's class is Wage Reporting, Fringe Benefits, Other Income, and the Foreign Earned Income Exclusion, all in 2 hours. So it's going to be a busy, jam-packed day. And as we're getting going with today's class, I wanted to remind you to stay tuned for passwords. I'll be giving you 2 passwords today, and you need to write those down when you hear them so that at the end of today's class, you can take the password test and pass it. You do need to be able to pass the password test to get credit for completing today's class. I'm going to move to the second page of our manual today, and you can access this manual from inside the materials page of Open Campus, which is our learning management system. On the second page of the manual, the heading is Form 1040, line 7, wages, salaries, tips, etc. And we're going to be spending a good part of today's class talking about the first income line that appears on the Form 1040. It would seem rather mundane and elementary, line 7. After all, how difficult can it be to look at a W-2 and pull the wage number off? But there's actually a lot to be said about the W-2. And much of what I'm going to be talking to you today about is actually going to be looking at the W-2 from the employer's perspective, the type of income an employer is supposed to be reporting on a W-2, and when an employer can give a fringe benefit to an employee that does not need to be reported on a W-2. And we're also going to be looking at oddball wage items that an employee may need to report on line 7 as wage income, even when they haven't received a W-2 for that income. So let's begin at the top where it says line 7 of Form 1040 is used to report the taxable compensation received for services you perform as an employee. And what we're going to be looking at in this introductory part of the course is the definition of an employee. The reason we're going to talk about it is that lots of people seem to be really confused about when they have an employee and when they don't. Sometimes it's the employee that's confused, and sometimes it's the employer who is either confused or just trying to save a buck by violating some payroll laws. So we're going to look at the definition of an employee and also some of the little things that employers might be doing to try and navigate around payroll taxes when they shouldn't, and some of the options that you might have available with a client when you run across this. So let's look first at determining if you are an employee. An employee is a person who performs services under the direction and control of an employer. And you should remember this simple rule of thumb, and that is that if an employer has direction and control over the performance of services, by definition, the person they are controlling is an employee. And it really doesn't matter whether the employee performs services on the work site of the employer or from their own home. What matters is direction and control. So let's look at a few illustrations here to help perhaps clarify a little bit the difference of an employee. You work for XYZ company as a secretary, and you are told what hours to work and how and where to perform your duties. You are an employee, and your employer should withhold taxes and issue you a W-2. Number 2, assume the same as for illustration 1, except you are self-employed as a secretarial services provider. There's not too many people out there self-employed as a secretarial service provider. That's not really going to happen. But in this case, you're actually running a staffing agency. You mark your business to many different clients, and you employ a staff of secretaries whom you send to work at various companies. You have control over where and when you work, and sometimes you perform secretarial services for your clients when one of your own employees calls in sick. Because you are in control of your own business, you are not an employee and you are self-employed. Number 3, you are a nanny, and you are responsible for the care of 2 children at Mrs. Jones' home. Mrs. Jones tells you how and where to care for her children, and that makes you her employee. Now, there's a special rule for household employers, and that is that with most employers, if you pay any wage at all, even $1, you need to issue a W-2 to that employee at the end of the year. And I've seen plenty of instances over the years where I've had a tax client come to me with a W-2 for like $10. They worked 1 hour or half a day or whatever it was, and it didn't work out, and so they were laid off, and they got a W-2 for that tiny little bit of time they were there. But when you're looking at household employees, there's actually a provision that says that the employer, the household employer, does not need to issue a W-2 to their household employee until they've paid them $1,900 or more for the year. That's specific only to household employers, and it's really to get around the issue of parents who employ babysitters so that they can go out for an evening on the town, and do they really need to be W-2ing all their babysitters throughout the year? The answer is no, but when there starts to be really more of an employer-employee relationship in terms of a nanny coming into the house on a regular basis, then the W-2 does need to get issued when wages hit $1,900. Now, in the situation of the nanny coming to the home of the family, by definition, that situation is always an employer-employee relationship. But if you take your child to the daycare center of a child care provider, now you are not an employer. Now you are taking your business to another business, and you're taking your children to a daycare business. And that daycare business definitely would not be your employee, and so you would not need to W-2 your daycare business. But let's take a look a little bit at the daycare business, because I think this is a good opportunity for me to bring up that topic I mentioned, which is when an employer is maybe not doing payroll the way they should. And I actually have a fairly recent case I ran across with an actual daycare center here in the Portland, Oregon area. Client runs a nice, successful, now established, but at the time still fairly new, daycare business. And she's got a good following of clientele bringing their children to her business. And when she first started it up, she decided she wanted to keep it small, and she was really only going to employ herself. And she's a sole proprietor, so she's not really an employee, plus 2 or 3 other child care providers to work under her. And her husband talked on her behalf to their tax professional at the time about what to do in terms of handling the staff inside this daycare center. And the accountants that they were working with didn't appear to be very knowledgeable on the topic and didn't tell them they needed to run payroll. And one of the workers they hired declared that she always works as an independent contractor. And so that's what they did. They employed this person as an independent contractor, and they employed another person as an independent contractor. And then they decided that they really wanted to get a new preparer, someone who knew more about business than apparently they were getting from their old accountant, and they ended up sitting in front of me. As they were sitting in front of me and I was looking at their list of expenses, I looked at these payments to their staff and asked about the payroll and the W-2s, and they said, well, there weren't any. They were going to be 1099ing them. So that's where my little warning flag started going boing, 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 because I know for a fact that under the rules for direction and control that they, in fact, had employees here, not independent contractors. Well, the good news is that this client is actually a very ethical, conscientious client who really was trying to follow the law. That's why he left his old accountant and found me. And so I was happily able to tell him about a provision in the law right now, basically procedures that the IRS has in place to allow voluntary compliance for business owners who have been outside of compliance with their payroll practices, essentially a system where they can come into compliance without the fear of repercussions or penalties now or in the future. So we took advantage of this voluntary compliance procedure, and the cool thing about it is you look at all of the payroll that has been paid to all of the staff of this employer from the point in time we're starting now back in time, and figure out what all the payroll tax on that payroll would have been. You then multiply that payroll tax by 10%, and you pay 10% of the total tax you would have owed if you had properly filed in the first place, along with the application, and you're given a clean slate. It's a superb deal, one that you should definitely look to take advantage of for your clients to bring them into compliance, because if they are not in compliance and they are selected for audit by the IRS, it can be very, very punitive. The IRS can come along and assess all of the tax that was originally owed, plus penalties, plus additional taxes for withholdings they should have done on employees' pay and didn't. It's an ugly mess when the IRS does a payroll audit and finds them this way. And I should let you know that states do payroll audits as well. And here in Oregon, I actually see payroll audits done more frequently by the state than I do by the IRS, but I see both of them trigger them. And small business owners who are issuing 1099s to their employees are probably going to be raising the eyebrows of auditors who might be examining their files. So with that said, let's take a look now at Form W-4. Because once you've established that you have an employer-employee relationship, the W-4 needs to be completed by the employee. And I could talk a long time about the W-4, which we could say is a mundane document, but on the other hand is actually a crucially important document for purposes of the employee. The employee coming in to have their taxes done with us tax professionals each season wants to have the comfort of being able to predict where they're going to fall tax-wise. Are they expecting a refund, which they then get? Are they expecting to owe, which they then owe? That would mean that they're withholding at a rate that perhaps makes sense to them. But very often it is the case that an employee has no idea why they owe or why they have a refund or how Form W-4 got them to the point that they're in. And I fault a number of things for this. The first thing I fault is the fact that there was a change to the withholding tables way back in the first Bush administration, actually near the end of Bush 1's administration. And at that time, the withholding tables were changed so that if you had been claiming single 2 in the past and received a refund doing that, all of a sudden it became the case that single 1 was barely break even and you really needed to do single 0 to get a refund. So the actual rate of withholdings, I think, is just not quite right. The other thing is that the concept behind the design of the document and the withholdings themselves were created on this conception of the historical traditional family where the man went to work, had a wife at home with 2 kids, and she wasn't earning income outside the home. So when you look at the document, W-4, and you see this box right here that says married, many people who get married assume that they have to check that box. The problem with the married box is that it really only works when only one spouse works. By that I mean if only one spouse works and the other doesn't, then checking the married box actually does work out. But if both spouses are working, the problem is that spouse number 1's job and spouse number 2's job don't know about each other's jobs. There's no accommodation in the withholding tables for the fact that the other one has a job. And if they both claim married, they're both going to probably under withhold because married filers pay more tax than 2 single filers. So married filers should either select single or married but withhold at the higher single rate, which is in effect the same thing as single. The other thing to be thinking about is that every exemption you enter on this document, and you can see here line 5, it says enter your total number of allowances. Those total number of allowances represent the number of exemptions you'll be able to claim on your tax return. When I actually file, am I going to be able to claim an exemption for myself, for my spouse, and my 2 children? If I'm going to be able to claim 4 exemptions when I file, then I can put 4 there. If both myself and my husband are working and supporting the same 2 children, if we both claim married 4, when we actually combine our incomes, we will have done the equivalent of having claimed 2 standard deductions plus 8 exemptions when you add up our 2 rates of withholding. And so that can put us in a situation where we owe, unless we're eligible for itemizing deductions for mortgage interest or other offsetting items to compensate for the fact that we've claimed equivalently so many exemptions. Now, the same thing can happen to a single person. Let's suppose you're single. You're not having to worry about what's going on with another spouse and that spouse's job, but you yourself have 2 jobs. Well, if you go to job 1 and say, I'm single and I'm going to claim 1 for myself, and then you go to job 2 and say, I'm single and I'm going to claim 1 for myself, well, when you add those 2 jobs together, now you've just claimed 2. And not only that, the first job and the second job are going to do withholdings assuming that they are the only job and that by the end of the year, your annual income will average out to that 1 W-2. So if you take W-2 number 1 for $30,000 and W-2 number 2 for $10,000, the rate of withholding that you need to have averaged for the year between those 2 jobs needs to be for a person earning $40,000. But neither job knows about the other job in terms of how the withholding tables work. So I always recommend to clients when they are single and working more than 1 job that they claim single 0. And, they may have other deductions and so forth that can compensate and allow otherwise. But typically when I'm having a conversation with my clients, it's either because they want to have a refund or they don't want to owe too much when they file. And these are the places that I see that they owe and why. Married couples, again, are the ones most likely to see huge fluctuations, especially when you have one spouse, say, earning a pretty decent level of income, $50,000, $60,000, $100,000, and the other spouse earning only $10,000, $20,000. Now you've got a situation where the spouse earning $10,000 or $20,000 on their withholding tables is in a much lower bracket, and the spouse earning $50,000, $60,000, $100,000 is in a higher bracket. And when you add those 2 numbers together, effectively the spouse earning less money is being taxed at the higher rate of the other spouse. And so those are all things to account for. And the instructions for W-4, when you read them here, they're horrible. Even tax preparers like me reading those are going like, what is this thing saying? I'm so confused. I have to do all these computations. It's really beyond the capacity of most filers. And even trying to show or explain it to most filers can be difficult. So ultimately, I just think about what's going to happen on the tax return. When we file the tax return, what will the filing status be? Does the other spouse, if there is one, have a job? How many dependents will there be? Are there going to be deductions or credits? And does my client want a refund or do they want to break even? All of those need to be answered when you're assisting a client with a W-4. All employers are required to issue the W-2 to the employee by January 31st of the year following the end of the year. And when issuing a W-2, the employer will normally mail or email or perhaps hand deliver 3 to 4 copies of this document to each employee. The employer is also required to submit copies of W-2s to the Social Security Administration. This can be done electronically or it can be done in the mail. If it's done in the mail, the employer has to create this W-3 form, attach all the W-2s to it, and mail it off. And then Social Security processes it. And a lot of people don't know that the Social Security Administration is actually the organization that receives and processes W-2s. It's not the IRS. And so IRS actually doesn't know what's on a W-2 until a substantial period of time has passed. And it can be as much as 18 months from the time a W-2 is issued until the time where the IRS can reconcile what appears on a W-2 against an employee's tax return. And so what this means is there is an opportunity, A, for fraud, and B, for errors that are not due to fraud, where erroneous reporting happens on a tax return and the IRS is unable to prevent that erroneous reporting. In other words, it can only react to it. It can't prevent it. It does try to prevent it in certain situations where it feels, say, the Box 2 withholding is really exorbitantly high next to the Box 1 wage. It might say that is such an extreme level of withholding, we don't really trust it. We're going to not issue a refund to this particular taxpayer until the taxpayer provides us with a copy of the W-2. I do see that happen occasionally during the tax season. But for the most part, whatever the filer puts on their tax return as appearing on the W-2, the IRS really has to rely on that under this honor system, and it is only able to follow up on that later on, as much as a year and a half later. Now, if there is an error on a tax return where the reporting on the tax return differs from the income reported on a document that the IRS has in its system, the IRS will issue a letter called a CP-2000 letter. And the CP-2000 letter says, hey, on your tax return you reported $30,000 of wages, but we have records here of $70,000 of wages showing on W-2s, and because of this, we think you owe blank dollars. And now is your opportunity to explain to us why you left this income off, or maybe the income didn't belong to you. Perhaps someone else used your Social Security number and that W-2 isn't even yours. But now is your opportunity to explain to us why the income either wasn't reportable or to pay up. And so that's how it typically goes. So we're going to take a little bit of a look at the W-2 here, box by box. And we're going to begin by looking at the top part of the form where you see the employee's Social Security number. What could I possibly have to say about a Social Security number that's interesting? Well, actually quite a bit. Firstly, the number that appears as the Social Security number of the employee should be the employee's actual Social Security number, but sometimes it's not. An example of when it wouldn't be is there's just simply an error. The employer has an error on the W-2, and you're observing with the taxpayer that it is the wrong number. If that happens, you should send your client back to the employer to request a corrected W-2 that has the correct Social Security number on it. But another reason why the W-2 could be wrong is when you're dealing with an undocumented worker who is actually working in the United States in violation of the law. Lots of them all over the country, millions of them, undocumented workers here in the United States who are working for employers using false Social Security numbers. Well, how do they get a false Social Security number? They can pull it out of the air. I can give you a number right now, 657-22-1134. Somewhere that's a number. It might be a number that was given to someone. It might be an unissued number. But if I go and make a fake Social Security card up with that number on it and use it to get a job, my employer is going to stick that number on the W-2. But it's not going to be possible for that particular undocumented worker to file using that fake Social Security number. Instead, they're going to need to apply for an actual taxpayer identification number or an ITIN number. And they do that by attaching Form W-7 to the first year for which they are filing a tax return with the IRS. Because even though they're working in the country illegally, they are still required to file tax laws. And many of them are very concerned about doing so, because even though they're undocumented and illegal at this time, they may be looking to a future where they can go through the immigration system and become legal. And part of that immigration application is to show that they're in compliance with tax law. And sometimes undocumented workers are entitled to refunds that they want as well. Very often that's the case, at least with the undocumented workers I've worked with over the years. So what we're going to be looking at now is what happens when the W-2 has the incorrect Social Security number for an undocumented worker. And the answer that IRS has is if you aren't going to be notifying the employer because you don't want the employer to know you're undocumented, then what you should have done is get the taxpayer to actually draw a line through the incorrect Social Security number on the W-2 and handwrite in what the correct number is. And then you would file the return using that correct number. Now, I know that our Drake software actually has a box on the screen for the W-2 where you enter the identification number that actually appears on the W-2. So if you have a W-2 that has a fake Social Security number on it and your client is filing with their correct ITIN number, then you would use the ITIN number on the front page of the 1040 as the taxpayer identification number. But when you're in the electronic filing screen and you're entering W-2 information, you're going to need to enter on the bottom of the screen or wherever your software has you do it, the Social Security number that actually appears on the W-2. And Drake actually notices when you should be filling in that screen. And the reason it notices is because all ITIN numbers always begin with the digit 9. And when you are doing data entry and you indicate that the taxpayer identification number begins with the digit 9, at least Drake software automatically says, oh, wait, that looks like it's an ITIN number. So when it gets to the W-2 screen, it says, you're using an ITIN for this filer. What's the Social Security number that's on the W-2? And IRS needs to know what Social Security number is on the W-2 because if the fake number that appears on the W-2 belongs to someone other than the person filing the return, then IRS needs to know that that wage income should not therefore be allocated to the Social Security number that actually appears in that W-2. And this situation of W-2s and wrong Social Security numbers on them causing grief for the valid owner of that Social Security number has gone on for decades. I can remember when I newlywed my husband way back in 1990, we were still newlyweds, he actually got a letter from the IRS, he was in the Navy, saying that he owed money because he hadn't reported income. It was a CP2000 letter of the day, and it accused him of underreporting wage income and basically stated that he had worked in California for a period of time and earned this money. And it was easy to substantiate he hadn't earned the money because he was out at sea in the Navy. He didn't earn that money, but it was months and months and months just to prove that he couldn't possibly have earned that money. So to alleviate the need for that kind of stressful impact on the true owners of Social Security numbers, the IRS does have a system in place where ITIN number users should be entering the Social Security number that appears on the W-2 so that IRS can know that that wage income does not belong to the person who actually owns that number. All right, we should also have on here the employer identification number. I already have another story for you on the employer ID number. We've had a young woman coming to our tax service for a few years now. This was the first year I personally worked with her. She'd been with other members on our staff. But when I sat down to work with her on her tax return this year, I noticed these notes screens saying that she had to file paper because there was an invalid ID number on her W-2. And she was working for a household employer, and he was issuing her a W-2 using his Social Security number. And therefore, we couldn't e-file. And I said, this is just ridiculous. He needs to get an EIN. And apparently, he's an old guy, and he is the one that hired her to be his care provider. But the actual issuing of the W-2 and the issuing of payroll was happening through his son, who was basically taking care of that issue. And I said to my client, this is just ridiculous. So I typed up a letter for her to take to her employer's son. And the letter said, essentially in so many words, you need to get your dad an employer identification number. It is inappropriate and incorrect to be using a Social Security number. Furthermore, I am concerned that the payroll withholding and the payroll tax that is being paid on this employee's wages are probably not being registered in the Social Security system the way they should be. And this concerns me greatly. I don't know if she's getting credit for her Social Security benefits in the future when this document is not being handled correctly. It's possible that it is. I really don't know how it all works there. But it occurred to me that Social Security may not be accurately recording the actual wages that she's been receiving. Got an email from the son saying, we can't imagine why you think that this is all improper. And so I then emailed the son copies of the instructions for Schedule H, which is the household employer form. I emailed the instructions for the link to apply for an EIN and essentially said there's no excuse for not having one. It is free to get one. It takes only a few minutes. Here are the rules that say you must have one. And lo and behold, it was about 3 weeks later, she came back to me with a corrected W-2 and an EIN on it. So the first time ever we were able to e-file her. My goodness, we've spent this much time talking about the first two boxes on the W-2. Of course, we have the box for the employer name and address, the employee's name and an address. Now let's move on to box 1. Box 1 is an important box. That is the box that you typically are going to carry whatever number is in it onto line 7 of the Form W-2. And box 2 is pretty important too because box 2 shows the number that you're going to carry to the withholding line on 1040. Now, box 3 can be important. Social Security wages and Social Security tax withheld. There is actually a limit on the amount of wage that you have that can be subjected to Social Security tax. And so for that reason, you actually have a max out amount on box 3. I think it's $119,000 this year, and it's indexed for inflation every year. It's actually $117,000 for 2014. So it goes up a certain amount every year. And most of the time, when we look at this box 3, it is going to be, well, I can't say most of the time. Box 3 can be equal to box 1, but it can also be more than box 1, and it can be less than box 1. Box 3 will be more than box 1 if an employee has made an elective deferral to, say, a 401k plan or a 403b plan to invest for their retirement. And those investments that they do for retirement are deductible against income tax, and so do not show in box 1, but they're not deductible against the Social Security and Medicare tax. And so when you see a code D in box 12, you should typically expect to see box 3 and box 5 both being higher than box 1. And box 5 has no maximum amount. So box 5 is where you will see the gross Medicare wages. Box 5 is often equal to box 3, which can often be more than box 1. But because box 3 maxes out at $117,000, if you are working with a higher wage income earner, you will frequently see box 5 being higher than box 3. And the other thing to be making note of for box 5, what is special about it now, is that under the Affordable Care Act, the figure that appears in box 5 is the figure that is used to calculate the additional Medicare tax. So when you're looking at a W-2, you see Medicare tax withheld, and it is based on the amount appearing in box 5. And typically, the withholding rate is 1.45% of the wage in box 5 is going to appear in box 6. But if the wage amount in box 5 goes over $200,000, then box 6 will be more than 1.45% of box 5 because the additional Medicare tax kicks in. And to the extent that box 5 exceeds $200,000, you're going to see a 0.09 additional withholding in that box. And we talk about the additional Medicare tax in other courses that we teach, including the tax aspects of the Affordable Care Act and also under other taxes. So I'm not going to show how that works today. Then we move on to box 10. Box 10 is where we show dependent care benefits. And dependent care benefits allow an employee to reduce their salary by up to $5,000 a year. And the good thing about dependent care benefits is that it can offset not only income tax, but also Social Security and Medicare tax. It is a salary reduction amount, and as long as they spend the amount in box 10 on qualifying child care for a qualifying child, then there is a tax benefit to them. Now, the child and dependent care credit is a credit that a taxpayer can claim to help offset some of the costs of child care. And the credit is impacted by the benefits appearing in Box 10. If you have an amount appearing in Box 10, you automatically have to attach 2441 to the client's tax return to figure whether or not they need to include some of the dependent care benefits back into income, or if they're able to even perhaps completely offset their income and maybe even claim a little bit of an additional child and dependent care credit. The child and dependent care credit maxes out on a maximum of $6,000 of expense if you have 2 or more children. So if you claim dependent care benefits of $5,000 and you have 2 children and you paid at least $6,000 for child care, you're still going to be able to claim a credit on $1,000 of expense. But if you have only 1 child, you're only able to claim a credit based on $3,000 of expenses, whereas you can offset salary by up to $5,000. So the dependent care box is especially relevant to taxpayers who have only 1 child because they actually get a bigger benefit, can get more of their child care costs taken against tax by doing it through their employer on the W-2. But either way, anytime there's a number in Box 10, you're going to have to attach 2441 to show either that part of the amount is taxable, and if it is taxable, the taxable part will carry to line 7 of the tax return and get reported as wage income. And if it's fully non-taxable, the 2441 will show the qualifying child care expenses and the dependent for which those expenses were paid. Moving on, we now have Box 12 is a box that notifies the IRS of certain amounts that are appearing on the W-2 and other boxes, and it can describe certain tax benefits that an employee has received, and those benefits are described through a series of codes. So IRS uses Box 12 for the employer to report to the IRS benefits that are being given to an employee. Box 14, on the other hand, is basically a carte blanche box. It is whatever the employer wants to use it for to communicate information to the employee, and the IRS doesn't really care what you put in that box because they're not really using it for anything. There's one exception to that, and that is California has the State Disability Insurance Program, SDI, and Box 14 is frequently used by an employer to report SDI payments on behalf of the employee or that were withheld from the employee's pay. And so an amount appearing in Box 14 with SDI next to it could be deductible on Schedule A, but it also is relevant to the preparation of the California return. Then moving on down to Box 15. Box 15 shows the state that wages were earned in. So if you are a worker in the state of Illinois, you should have a code IL in Box 15. You would enter the Illinois Tax Department's identification number and then the amount of wages attributable to work performed in Illinois, and then the state income tax withheld and paid to Illinois. Now, when it comes to line 15, it is not at all uncommon for me to see errors on line 15, especially the case when you've got workers who are working in a state that is different than the home state of the employer, or you have workers who have moved from one state to another and maintained the same employer. It is not at all uncommon for me to see wages appearing in a particular state, even though the worker didn't earn those wages in that state. The first logical fix for that is to have the employee go back to the employer and ask the employer to correct it. It's rather important that they do, because if the employer has issued a W-2 with a code IL for Illinois, but the worker actually worked in Missouri, then unemployment taxes have been paid to Illinois when they should have been paid to Missouri. And withholding tax has been paid to Illinois instead of Missouri. And since the employee worked in Missouri, Missouri is where they should be filing their return, not Illinois. But sometimes employers are not willing to fix this problem. And when that happens, ultimately the only way to deal with it is for the employee to file returns with both states, get a withholding, in this case from Illinois, and then turn around and pay what they owe to Missouri. That happens regularly every tax season. I see at least 1 or 2 clients that this has happened to. Then finally, moving across the W-2, we get to Box 18, local wages, tips, etc. Most people don't live in a jurisdiction where there is a local tax, but some people do. For example, Californians do have this California state disability tax that can also be entered in Box 18. Well, actually, the withholding happens in Box 19, the wages reported in 18. But there are a number of other jurisdictions throughout the country where there is a local tax. Philadelphia is one that comes to mind right now. I run across Philadelphia quite frequently, even though I'm here in Portland, Oregon. All right, so I'm going to move on to page 7 and 8 of the manual, and I wanted to come back to this Social Security wages box. And I mentioned that the Social Security wages box maxes out at $17,000. But even when it hasn't maxed out, it can be a number that is different than the wage box for a reason other than contributions to a 401k plan. There's actually situations where the wage box can be higher than the Social Security box. That happens sometimes. And it can kind of raise your eyebrows and sometimes even confuses your computer because the computer thinks there should be a number in box 3 when there is no number in box 3, or it's auto-filling a number in box 3 that is actually the wrong number. Let's take a look at some of the reasons why box 3 could be lower than box 1. The first one we run across is wages paid to clergy, because the rules relating to clergy are actually very specific. Clergy are really deemed to be self-employed. However, they're self-employed for self-employment tax purposes, not for purposes of being an employee. So when you have a minister working for a church or other religious organization, that minister should receive a W-2 and not a 1099 miscellaneous. Now, a lot of churches are pretty darn small, and they're employing tax professionals who may not be aware of these rules, and the church probably isn't aware of these rules when it's a small church. It just wouldn't have the resources to be paying for more expertise very often. But the rules for most churches are that the ministers that they employ are not supposed to do Social Security and Medicare tax withholding on them, and they're not supposed to 1099 them either. So if you have a church that actually is on the ball doing it correctly, the church will actually issue a W-2 to the minister with wages in box 1, withholding in box 2, and boxes 3, 4, 5, 6 are blank. That's the correct way for a church to handle its minister wage paid. When the minister files his or her return, that minister will attach Schedule SE to figure the self-employment tax that they owe. And what does sometimes happen when I see churches doing this correctly, you will see that box 2 has a huge number in it, because the number that the church is withholding for that minister is enough to offset the Social Security tax that the minister is going to owe when they figure their self-employment tax. So if you're working on a tax return for a minister and that minister has a church that's on the ball and is issuing a correct W-2, you should see a number in box 1, a number in box 2, and boxes 3, 4, 5, and 6 should be blank. Anything else, and it's probably wrong, but the most common thing I usually see is a church has issued its minister a 1099 miscellaneous. And it is not always going to be wrong for the church to do that, but it usually is. And sometimes I lose my breath explaining to my clients why this is the case. But if you want to find out more on the subject from an authoritative source other than my voice, you can visit IRS Publication 517 and take a read there. Now, another reason why box 3 could be higher than box 1 is you may be working with a police officer or a firefighter, and certain state employee groups, such as police officers and firefighters, can be exempt from the mandatory Social Security tax because they are covered by a public retirement system, also referred to as a FICA replacement plan. And these employees may or may not also be covered optionally for the Social Security under a Section 218 agreement. So that is why police officers employed by the City of Portland, box 3 is always blank, but Medicare box 5 is not. Interesting. The next reason why you might see a higher number in box 1 than in box 3 is if you are looking at the W-2 for an S corporation shareholder who owns 2% or more of an S corporation for which they are performing services. Because if they are performing services for their S corporation and they are a 2% or more shareholder, any health insurance premiums paid on their behalf by that S corporation are deemed to be a taxable wage to them and get reported in box 1. But interestingly, they are not taxable for Social Security and Medicare tax, and so you will see in that situation when you are dealing with an S corporation shareholder that the wage box should report the benefit cost of health insurance, and that benefit cost does not carry into boxes 3 or 5. And finally, of course, the wage box can be higher than the Social Security box when employees' wages exceed $117,000. So if you're looking at a W-2 for an employee who earned $130,000 for the year, it is obvious that the Social Security box will be a lower number. All right, so let's move on now to the next box I'm going to look at, which is box 8, allocated tips. It's this one right here. And actually, while we're at it, we may as well be talking about box 7, Social Security tips. Tips are a funny one. I don't run across a terrible number of people who have tips or allocated tips, but when you do run across them, you should know what to do. And there's kind of hard, fast rules on this. There's no gray area in here. Certain things are going to happen when certain numbers are reported in these boxes, and you need to know what to do when you see them. So we're going to spend some time on that today specifically. But under the law, certain types of restaurants and bars have to report tips in proportion to their gross receipts from food and beverage sales. Typically, the number is 8%. So if a restaurant had $100,000 of sales in a particular month, it should be reporting at least $8,000 of tips during that same month, because that would be 8%. But they would need to be reporting at least that much in tips. And if they aren't, under the formulas and the rules that the IRS has, the employer would need to be looking at the employees, and those employees who have not reported at least 8% in tips can be given an allocation, and that allocation is done in Box 8. And essentially, whatever number you see in Box 8, when you're filling out the tax return, you need to take Box 8 and add it to Box 1 and enter the total on line 7 of the tax return, unless the employee can prove they didn't get those allocated tips, in fact, because they had a tip log and can show that the actual amount of tips they received is less than the amount that they're showing as an allocation. Now, an employee, when they're hired by their employer, is usually given a flat wage. In some states, that flat wage can be less than the regular minimum wage, and in other states, the minimum wage is the same whether you work in a restaurant or not. So Oregon is an example of a state where whether you work in a restaurant or you work over at Safeway behind the cash register, it's the same minimum wage. But whatever that minimum wage is that the restaurant employer is paying to their server, that wage appears in Box 1. Then there is a breakdown of the actual wage being paid to the worker, and that is entered in Box 3. And then the worker, the server who is receiving tips, is supposed to report to their employer how much they received in tips. And that employer is going to add whatever amount of tips the employee reported to them into Box 1. And then it's going to identify how much of the wage in Box 1 is for the base wage of the employee and how much of the wage in Box 1 is for the Social Security tips or the tip income that that employee reported. So what will happen then is that Box 7 plus Box 3 equals Box 1. And if you take Box 7 plus Box 3 and take the total and multiply that by 6.2%, you're going to get the amount that appears in Box 4. That's when things have been done correctly. And if the amount on Box 7 does not total 8% of that particular server's sales for a particular month or year, then it could be the case that there will be an allocation of tips in Box 8, and the employee is required to pay tax on those tips unless they can prove they didn't get them through a tip log. Moving on to the W-2, so remember I told you Box 12 is where you would enter the amount of salary deferral or other relevant income items that the IRS needs to have explained to them. The most common one I see in Box 12 is a Code D for 401k deferral, but you can also frequently see in Box 12 Code C, if we come down here to the bottom of the screen, Code C, which is the taxable cost of group term life insurance over $50,000. And really, Box 12 could have any number of codes in it, and according to the instructions on Form W-2, the code that you see in Box 12 is described as you see here. So we have Box 12 Code D, that represents elective deferrals to a 401k plan. Code E represents elective deferrals under a Section 403B plan. 403B plans are usually plans that are available to government employees like teachers. And then we keep going, we can see Code G, elective deferrals and employer contributions to any Section 547 deferred compensation plan. Code J, I see that fairly often, that's non-taxable sick pay. And the list goes on. Here's another one, P, excludable moving expense reimbursements paid directly to the employee. I watch out for P because when I have a new client come to me for the first time, frequently they're coming to me for the first time because they've moved to Oregon from another state and they've just basically found a new tax preparer and I'm it. And so when I'm having the conversation with them about moving expenses, my mind is always wrapped around who paid the moving expenses. Did you pay them? Did your employer pay them? If you paid them, did the employer give you reimbursement for that amount? Or did the employer just give you a gross up on your payroll to pay your moving expenses with using after-tax dollars? But the Code P tells me that the employer has given that employee a tax-free reimbursement for moving expenses or has possibly even paid the expenses directly itself. So Code P is pretty important. We talk about moving expenses actually in a class I'm teaching next week, which is above the line deductions. So we'll get more into Code P and how it's relevant to the preparation of a tax return when we look at 3903 in my class on above the line deductions. Let's move on now to box 13, which is where employee information is entered. These boxes are actually very important, and you need to pay attention to what's in them. When you're working on your tax software, you need to tell the tax software whether box 13 has check boxes that are checked. Because if they are checked and you don't tell the software that they were checked, the software could produce an error on the tax return. For example, if the retirement plan box is checked, and it frequently is, and you don't tell the computer that it is, and then your client says, I put $6,000 into my IRA this year, your software is going to give them a deduction for that $6,000 IRA contribution because it doesn't know that they might not be eligible for it. So when an employee has a retirement plan at work and then they make a contribution to an IRA, it could be the case that contribution to their IRA is deductible, but could also be the case that it's not deductible. And if the retirement plan box is checked, then the contribution could become non-deductible based on their income level. And we get into how you figure the deductible part of an IRA contribution in the same class, above the line deductions, next week. Also, statutory employee. This box is checked when you are working with a person who really under common law is considered to be an independent contractor, but under statute is deemed to be an employee. And when that happens, you have a special situation. It doesn't come up very often. I only see one of these every 3-4 years. But when I do see one, it means that this particular employee is going to get some special tax benefits to them. The first tax benefit is that they are able to deduct their employee business expenses on Schedule C, and they do not need to itemize their deductions or subject their expenses to the 2% limit. So you literally have a W-2 with an amount on box 7, and you will prepare a Schedule C to claim the expenses. The Schedule C will offset the wage income from box 1 of the W-2 and carry the net income to line 7 of the 1040. So that's an important box when it's checked. And if you want to know a little bit more about what a statutory employee is, I have some notes here on that. Firstly, an agent or commissioned driver who delivers food, beverages, laundry, or dry cleaning for someone else could be a statutory employee. Also, full-time life insurance salespeople. A home worker who does piece manufacturing from their home could be a statutory employee. And then the final one is a traveling salesperson who essentially works for a single employer selling products of that employer to retailers. Those are the people that typically fall into the statutory employee category, but not all traveling salespeople qualify as statutory employees. If you are a statutory employee, you're essentially not eligible for any of the other normal types of benefits that employer might be giving, such as health insurance coverage and 401k benefit plans. Essentially, all you are is a statutory employee receiving a W-2. Your employer is required to pay the Social Security and Medicare tax and do withholdings on that, but for all other intents and purposes, you're self-employed, and so that's statutory employee. All right, moving on down. I've covered most of the W-2 now, and I wanted to get on to the next topic of the day, which is taxable wages and taxable fringe benefits. And I can see we're close to the top of the hour, but I'm going to cover this particular topic, and then we'll take a break. All right, so taxable wages. Federal law provides specific treatment to employee wages, and employee wages are generally subject to a variety of taxes, including Social Security, Medicare, and unemployment tax. And because employee wages are subjected to these taxes at both the employer and the employee level, there is clearly an incentive for employers to try and avoid these taxes by giving special perks or benefits to their employees. The worst case I ever saw of this, I had a client who came to me, and he was kind of a scuzzball as far as I was concerned, and I was glad when he went away. He had people that were helping him in his business, and he paid them by buying them clothes and giving them gifts. And I kept explaining to him that those were wages, and he needed to issue W-2s, and he needed to do withholdings. And he kept arguing with me that these were gifts, but then he wanted to deduct the cost of the gifts on his tax return. The whole thing was just a mess, and I'm glad he went away. He was really trying to violate payroll laws and get away with something, and no doubt the IRS eventually caught up with him. But you just can't do that type of thing. And his was a full-scale thing where he was refusing to give any payroll at all and do it all through fringe benefits. But many employers are going to try and do some amount of fringe benefit, and very often they do it unwittingly. And so the IRS is on the lookout for that. For example, if you are an employer who regularly brings food in to your employees for staff meetings and you like to give them nice dinners and take them to ball games and so forth, those things are going to add up and raise the eyebrows of an auditor, especially a payroll auditor. So those types of things we need to be on the lookout for as tax practitioners and be advising our clients on these. So when an employer gives an employee a benefit aside from the regular pay, these benefits are referred to as fringe benefits. And while some fringe benefits can be tax-free, most are considered to be the equivalent of wages and are taxed as if they are wages, because as far as the IRS is concerned, they are wages. So what are taxable wages? Well, the pay you receive can be paid in cash or in another form. So wages include salaries, vacation allowances, bonuses, commissions, plus fringe benefits. And it doesn't matter how these payments were measured or made to you, your employer should include these payments on your W-2 and withhold income, unemployment, Social Security, and Medicare tax. And all of the following payments are considered to be wages paid. The amounts an employer pays you as a bonus for signing or ratifying a contract in connection with the establishment of an employer-employee relationship. In other words, a sign-on bonus. An amount paid to you for cancellation of an employment contract. In other words, severance pay. Payments for you to relinquish your contractual rights. And compensation paid to you after you ended your employment if you performed these duties while you were still employed. So you work for this particular month, you're laid off, and 2 weeks later you get your final paycheck. That final paycheck is still a wage. So let's look now at some of the descriptions of taxable fringe benefits, some of the common ones that we should be on the lookout for. A fringe benefit is a form of pay for the performance of services, and fringe benefits are taxable and must be included in employee pay unless the law specifically excludes them. You generally must include fringe benefits you received in your income unless the benefits are non-taxable. And following are examples of taxable fringe benefits, including the free use of a company car, flights on aircraft provided by your employer, free or discounted commercial flights, free vacations, discount on property or services, membership in country clubs or other social clubs, and tickets to entertainment or sporting events. And there was something here about commercial flights, and it suddenly got my mind going. I just want to look for this code when we were looking at box 12, because I did a tax return for a pilot this year, and I also did one for a flight attendant. And I don't know if the codes here are showing it, but there is a code. Yeah, it's code L, substantiated employee business expense reimbursements. If your employer did allow you to use a company car and all of the use of that car was for business, then it doesn't need to be reported on your W-2 at all. But if your employer says, okay, you're using your own personal car and I want to reimburse you for the use of your own personal car, I want you to submit to me your mileage report and I'm going to reimburse you. And whatever amount the employer reimburses that employee can be indicated on the W-2 in box 12 with the code L. The reason I'm bringing up code L is that I've been doing tax returns for a particular flight attendant for probably 15 years, works for Delta. And 2014 is the very first year I ever noticed that she had this code L on her W-2 representing the reimbursements she was receiving for her travel expenses when she was on layover in Asia. So she wanted to claim expenses for her layovers in Asia, and I'm going, but wait, this box is telling me you were reimbursed for those expenses. So ultimately, I didn't give them to her. I also did tax returns for an actual airline pilot this year, and he too had these code L amounts for his layovers. I haven't noticed employers using that code in the past, so perhaps there's been a crackdown by IRS on it, and more people are starting to use it now. But let's go back to these taxable fringe benefits. Where an employer has given an employee one of these fringe benefits, you actually shouldn't be seeing a code L on the W-2 at all. They should just automatically bump up the W-2 by the amount, because when you see a code L on the W-2, that actually represents an amount that wasn't grossed up on the W-2 because it wasn't taxable. Moving on, in general, your employer must include the fair market value of these benefits to the extent that you are not required to pay for these benefits, and the value of fringe benefits is reported in boxes 1, 3, and 5 of your W-2, and there are special rules that govern how your employer values certain fringe benefits. Now, employer-paid or reimbursed moving and living expenses, non-deductible moving expenses paid by an employer on behalf of an employee are a taxable fringe benefit, and if your employer paid non-deductible expenses for you, they have to gross up your W-2 by the amount of these expenses. And as I said, in my above-the-line deductions class, we're going to take a look at how this appears on the W-2 and how it carries to 3903 and so forth, or if it can carry to 3903, but certainly how it carries to line 7 of the 1040. The most common types of non-deductible expenses that an employer will pay for an employee include house hunting expenses, real estate sales expenses, temporary living expenses, and meal expenses while traveling and living in temporary quarters. It's not at all uncommon for some of the larger employers with deep pockets to pay a premium to get a desirable employee. Especially here in Portland, the clients that I see this happen with most frequently are Intel and Nike. They're the two largest mega employers in our area. And these companies are always bringing workers in from out of state. And when they do that, they will pay all of their travel costs. They will pay the real estate commissions on the sale of their old home in the old state. They'll pay any other closing costs associated with the sale of the home in the old state. They'll pay the meal expenses while they're on the road. They'll pay house hunting expenses when they come to town. They'll pay for temporary living quarters while they're getting all of their stuff moved here. The thing is, all of those costs are non-deductible, and because they're non-deductible, the employer has to gross up the employee's wage by that amount, and it usually causes a huge jump in pay for the year of the move. So let's take a look now at some non-taxable fringe benefits. There are a few out there that an employer can pay for an employee and then not have to treat as wages paid to the employee. Examples include services provided to you by your employer at no cost to your employer, qualified employee discounts, working condition fringe benefits that are the cost of property or services that you could deduct as a business expense if you had paid for it. Examples include business use of a company car and subscriptions to business magazines. Certain minimal value fringe benefits, and examples of minimal fringe value benefits include an occasional cab ride paid for by your employer when you must work overtime, or local transportation benefits provided because of unsafe conditions and unusual circumstances, or meals provided at eating places operated by your employer if the meals are not furnished at below cost. So some employers actually have on-site restaurants and cafeterias that could be selling food at a fairly low price. And as long as that food is not being sold at below cost, then it can be tax-free. Qualified transportation fringe benefits subject to specified conditions and dollar limitations, including a ride in a commuter highway vehicle between the employee's home and place of work, transit passes, qualified parking, and qualified bicycle commuting reimbursement. For 2014, federal law allows the exclusion of these benefits up to the following threshold amounts: $250 a month for combined commuter highway vehicle transportation and transit passes, but beware that unless extended, this amount does revert to $130 for 2015. $250 a month for qualified parking and $20 per qualified bicycle commuting month. So an employer can actually pay up to $250 a month for an employee to park. However, what's interesting is that employees not allowed to deduct their parking expenses if they have to pay for parking, but the employer can give them up to $250 of free parking each month. So let's just say an employer pays $500 a month for an employee's parking. The first $250 can be excluded from wages, but the additional $250 per month would be grossed up on the W-2. Also, qualified moving reimbursements can be given tax-free to an employee, and where an employee has received qualified moving expense reimbursements, there should be a code P on the W-2. And the use of on-premises athletic facilities if substantially all use is by employees, their spouses, and their dependent children. And finally, qualified tuition reductions an educational organization provides to employees for education. And if you want to know more about these tax-free fringe benefits and taxable fringe benefits, refer to publication 15B. I've actually pulled a table for you here that comes from publication 15, and it contains a summary of the special rules for various types of fringe benefits. I'm not going to read these to you. I'll leave you to do that on your own, but you can see there's quite a list of benefits and the specific rules that apply to income tax withholding, Social Security and Medicare withholding, and federal unemployment tax withholding. Password number 1 is Brisbane, BRISBANE. So with that, we're going to talk about tip income. And I've already talked a little bit about tip income and what causes an allocation on a W-2 for tips. But let's look specifically now at some of the rules for tips. Because if you are working in a business where you receive tips, you need to know that all tips you receive are income and subject to income tax. And I can tell you, I've received tips as a tax preparer. I've had clients who said, here's a tip, April, you did a good job. And it's like, gee, thanks. That's wage income, and it needs to be reported technically to the employer, so the employer can include it in your wage and do the Social Security tax on it, but also because it's required in the law that you report it on your tax return. Now, if you are in a business where you regularly receive tips, you need to keep a daily tip record. And you need to report all the tips you receive to your employer, and you need to report all your tip income on your tax return. Now, your daily tip record could be something like this, just a book where you write down your tips for the day. It's totally acceptable, but a lot of businesses these days are pretty well computerized, and they actually, every time you make a sale, you enter your tips that you've received into this computer system. At the end of the day, you can get a printout that shows the tips you've received, and you need to keep a paper copy of it with your records. So why report tips to your employer in the first place? Well, your employer will be able to withhold income tax, Social Security tax, and Medicare tax on those tips when you do so. And your employer will then be able to correctly report your earnings to Social Security, and finally, to avoid the penalty for not reporting your tips. Allocated tips. Allocated tips are the amounts that your employer has to include on your W-2 because not enough tips were reported during the year. And if you get an allocation of tips on your W-2, you're basically stuck with it unless you can show that you didn't receive it. But if you did keep a tip record, the IRS considers that tip record to be proof that you did not receive either all of the allocation or at least some of the allocation should not be required for you to be putting on your tax return as income. So let's look at an illustration of what I mean here. Betty received a W-2 from her employer showing the following information. Her W-2 has Box 1 wages of $7,000 comprised of Box 3, $4,000 Social Security wages, and Box 7, $3,000 of Social Security tips. So you take Box 7 plus Box 4, and you get Box 1. But she also has a number in Box 8, $4,500 of allocated tips. Now, Betty was very careful throughout the year. She did keep a tip record, but she was trying to pull a fast one here. She underreported her tips on purpose. Her tip record shows that she actually received $5,000 of tips for the year, but she made a habit of only reporting the charge slip tips, which pretty much were no effort at all because her employer automatically knew about those, but she wasn't reporting her cash tips. And so she did record all of the tips she received during the year, but didn't report all of the tips she received for the year. So she's received this W-2 from her employer showing Box 1, $7,000, and Box 7 tips reported of $3,000, but her tip log shows she actually received $5,000 of tips, and Box 8 of the W-2 is showing she received $4,500 of allocated tips. Well, as far as the allocation is concerned, you're really taking the $4,500 of allocated tips and adding those to $3,000, and the argument is therefore being posed that the true amount of tips you received for the year is $7,500, when in fact the actual amount of tips received is only $5,000. So we're going to need to do some fancy footwork with Betty's tax return to figure out how much additional tax she's going to owe because of these unreported tips. And so we're going to go over and take a look at her W-2. And here is her W-2. $7,000 of wages received, $4,000 of those $7,000 are actual hourly wage, and $3,000 is tips. And what we're going to do is then move over to preparation of the tax return. And when we prepare the tax return, we're going to show $7,000 of wage reported in this box up here. Plus, we're going to add in the allocation amount that is taxable because it cannot be proved it wasn't received through her tip log. Her tip log shows she received $5,000 of tips. She only reported 3. The difference between what she actually received and what she reported is $2,000. And so we're going to add the unreported tips of $2,000 to the actual wages and tips already included on the W-2, and we're going to enter the total amount, $9,000, on 1040 page 1. We then move over to the next page of the manual and look at the 4137 in here. And on the form 4137, we show the total cash and charge tips she received for the year and the total amount that she reported to her employer. And then we show the actual amount of tips she received. And the actual amount of tips she received is $5,000. So the difference between 5 and 3 is the amount on which she has not paid tax, and we're going to need to pay 3 types of tax. The first type of tax is the Social Security tax. So we're going to take $2,000 and multiply that by 6.2%. We get $124. We're going to take $2,000, multiply that by 1.45%. We get $29. We add 124 to 129. We get 153. That 153 carries to line 58 over 1040. We check box 4137 to indicate this is the amount of tip tax she owes. And of course, way back up here on the preceding page, we're showing that $2,000 of unreported tips being added to line 7. So that is the correct way to report allocated tips and taxable tips on a tax return and on Form 4137. I have a little question here, and that question is, how much tip income would Betty have to report if she didn't keep a tip log? So if Betty had not kept a tip log and she had $4,500 of allocated tips, how much tip would she have to pay tip tax on? Well, she'd have to pay tip tax on all $4,500. So instead of entering $2,000 on line 4, she would have $4,500 on line 4. And instead of reporting $5,000 in box 2, she would have to report the additional amount, the full amount of tips received, $3,000 plus the $4,500 of allocated tips. So box 2 would actually show $7,500 if she had not kept a tip log. So she's actually contradicting the W-2 because she has a tip log and can prove how much tips she actually received. Now, it is likely the case that she will get a CP 2000 letter from the IRS asking questions about why she underreported her tips. In other words, her tax return is not reporting all $4,500 of allocated tips, and that is her signal to respond to that letter and send a copy of her tip log in to show that she can prove how much she actually received in tips. The next item we're going to look at is taxable scholarship and fellowship income. We're still on line 7 of the 1040. We haven't gotten off line 7 yet. Line 7 is also where you report taxable scholarship and fellowship income. These items are treated as if they are wage income. So a scholarship that you receive may be fully taxable, partially taxable, or not taxable at all. If you receive a taxable scholarship, you report the taxable part of the scholarship as wage income on Form 1040, line 7. And I have a little illustration here. We have a student named Steve Student, and he received a W-2 showing $5,000 of wages paid, and he also received a $20,000 scholarship, of which $13,000 was spent on qualifying educational expenses. So since only $13,000 of the $20,000 was spent on qualifying educational expense, the difference between those two numbers, $7,000, is actually going to be a taxable scholarship. And so he will include the taxable scholarship on line 7. So he's going to add his $5,000 W-2 wages to the taxable scholarship of $7,000. The sum total is $12,000. He'll enter $12,000 on line 7, and then he will write SCH 7,000 on the dotted line next to line 7. Non-taxable scholarships. So when do you not have to report and pay tax on a scholarship? Well, a scholarship is tax-free and is not includable on line 7 only if you are a candidate for a degree at an educational institution and you use the scholarship or fellowship to pay qualified educational expenses. A scholarship is not taxable to the extent that it is used to pay qualifying expenses, and the following expenses are qualifying educational expenses: tuition and fees required to enroll at or attend an eligible educational institution, and course-related expenses such as fees, books, supplies, and equipment that are required for courses at eligible educational institution. These items must be required of all students in your course of instruction. Now, expenses that do not qualify as tax-free include room and board, travel, research, clerical help, or equipment and other expenses which are not required for enrollment in or attendance at an eligible educational institution. Now, Fulbright grants, there's not a lot of those out there, but I certainly have a client who's been coming to me for several years who receives these quite regularly, in fact, every year. He is traveling to Europe under a Fulbright grant, and so there's some special rules that you should understand about Fulbright grants. Now, Fulbright grants that are awarded to U.S. citizens usually come from an agency that dispenses and administers these, and it could be a domestic Fulbright grant organization or a foreign. And for tax purposes, those Fulbright grants really fall into two categories. If you are a U.S. citizen who is the recipient of a Fulbright grant, you have to determine which of these categories your grant falls into in order to determine how the grant will be taxed for U.S. tax purposes. And Fulbright grants may be either of the following: a scholarship or fellowship income, or compensation for personal services, which are usually considered to be wages. For tax purposes, a scholarship or fellowship can be defined as an amount given to an individual and has the following characteristics. It is paid to aid the individual's pursuit of study, training, or research. It does not constitute compensation for personal services past, present, or future, and is paid more for the benefit of the grantee than the grantor. Now, in the case of my client, he is a brain scientist, and every year he travels to Germany, and he's in Germany for 2 months to 5 months, depending on the year, and he's paid quite handsomely through this Fulbright grant while he's there, anywhere from $20,000 to $50,000, $60,000 for the period of time that he's there. And he is doing research, training, study. He's not really performing employee services. Nonetheless, he's not working on a degree, and therefore it doesn't meet the definition of tax-free income. And so he does have to report it on his tax return and pay tax on it. Now, how would he go about doing that? Well, he's not going to receive a W-2 on it. It's basically through honesty that he's reporting it all. But he will go on the tax return and he will enter SCH on the tax return, much as we saw above, to indicate the amount of scholarship he's reporting on his tax return. Now, if he were actually performing services for the educational institution by teaching classes while he's there, then instead of entering SCH on the line next to line 7, he would just enter the foreign compensation on line 7 as wage without having an SCH next to it. So there's not a whole lot of difference. They both go on the same line. It's just that one has SCH next to it and the other doesn't. Now, because he is there to do work for compensation, he can deduct some expenses. It's appropriate. And there's numerous different ways under which this might happen. If a person goes over to a foreign nation for an uninterrupted period that includes an entire year, it could be that they can exclude wages under the foreign earned income exclusion. Or if the wages that they're earning are subjected to tax in that foreign nation, they might be able to claim a foreign tax credit because the United States and that foreign nation would then be taxing the same income. More often the case, though, one of the things that happens with Fulbright grants is individuals who travel to foreign nations under these Fulbright grants usually are exempt from tax by tax treaty, and the other nation, in the case of my client, Germany, is not allowed to tax his wages. Although Germany is not allowed to tax his wages, the United States still does. So he will be able to claim his travel expenses while he's there. He can claim the cost of airfare. He can claim the cost of lodging. He can claim a daily per diem expense, local transportation expenses while he's there. So he ends up with a pretty extensive Form 2106 that has some pretty high numbers on it because the daily per diem for meals in Germany is pretty high. So by the time we're done with his tax return, we may have claimed a deduction of $10,000 or more for meal expense for the length of time he was there. Not uncommon at all. So we've talked a little bit about the tax treatment of those Fulbright grants. If you want to read more about them, I have that information here. And also, there is an IRS Fulbright Scholarship webpage. And if you want to go read more about that, you can click on the link I have in the manual right here. The next line we're going to talk about on the Tax Form 1040 is line 10. So we're only an hour and a half into today's class, and we're finally moving off line 7 and on to line 10, which should be a pretty straightforward line. That is the line on which you report a taxable refund that you've received from a state. The biggest error I see go on with line 10 on the tax return is tax preparers entering a refund as taxable when it's not. When a client receives a refund that is taxable, it should be reported on a Form 1099-G that is issued by the state government that issued the refund. But just because a client received a 1099-G does not mean that the refund is actually taxable. You have to go through some calculations or observations to determine whether or not that refund is taxable. But the federal government refunds, just to point out that a client does receive federal refunds too, right? And I just wanted to remind you that federal refunds are never taxable on the federal return. There are certain situations where a state may tax a federal refund. For example, the state of Oregon, on rare occasions, will tax a federal refund, but only with respect to amended tax returns, and then not always. So for the most part, federal refunds are not taxable at either the federal or state level, but you should study state law to be sure. When we're talking about state tax refunds, though, the IRS will tax a state refund if you itemize deductions in an earlier year and claimed a deduction in that earlier year for taxes paid to the state and also received a tax benefit because you did so, and then that state refunds some or all of the tax that you claimed a deduction and a tax benefit for. So the real issue about whether or not a refund from a state is taxable circles around this tax benefit rule. There are plenty of situations where that state refund may not be taxable or may only be partially taxable, and examples of that are listed here. Firstly, if you're receiving a state refund for a year other than the prior year, so you're preparing a 2014 return and you've got a state refund card in your hand for 2012, well, when that refund is issued is important. If the refund was issued in an earlier year, it certainly isn't going to fall on the 2012 return. But ultimately, you need to go back to the year where that refund can be attributed to and see if there was a tax benefit on that year before you determine whether it's taxable at all. Also, if you receive a refund other than an income tax refund, such as a general sales tax or real property tax refund, that may or may not be taxable. The amount on your 2013 Form 1040, line 42, was more than the amount on line 41. Line 41 is income after itemized deductions, and line 42 is the exemption deduction. So if your exemptions are more than your income before exemptions, then clearly you didn't benefit from all of your itemized deductions. That's basically what this is getting on with. If you paid alternative minimum tax, that takes away any benefit from itemizing your deductions. Also, if you filed jointly in an earlier year, received a joint refund, and now you're filing separately, you're not going to pay tax on the full refund. You're going to figure out what portion of that refund is attributable to you and pay only your part. So you should see itemized deduction recoveries in publication 525 for more information about situations where your refund may not be fully taxable. The IRS does have a worksheet for figuring the taxability of your refund, but it does not take into account any of these special situations, so I consider that worksheet to be generally unreliable. Recovery of mortgage interest and other deductible expenses. As with your state tax refund, you should claim a refund of expenses as income if you previously derived a tax benefit by claiming the expense as a deduction. These don't happen very often, but I do have an example. You claim mortgage interest you paid as an itemized deduction on Schedule A, and then in a later year you receive a refund from your mortgage company for the overpayment of that interest. You will be required to include the refund of that interest as income on your tax return, but interestingly, you don't include it on line 10. You would include it on the interest line, which is line 8. Moving on, alimony. We're looking at line 11, and we're going to be talking about alimony next week in my above-the-line deduction class. When we look at it there, we're looking at when you pay alimony and if you are really paying alimony so that you can claim a deduction for the alimony you paid. Today we're looking at income. I'm the recipient of alimony, maybe, and do I have to include that in my income and pay tax on it? Now, if your former spouse pays you alimony under a divorce or separation instrument, you must include any payments you receive during the year as income on your tax return. And to be alimony, a payment must meet certain requirements. To determine if the alimony payments you receive are taxable, all of the following rules apply. The payments are required by a divorce or separation instrument. You cannot file a joint return with the spouse who is paying you the alimony. The payment is in cash. Your divorce or separation maintenance decree must not state that the payment is not alimony. You and your former spouse do not share the same household. There is no liability to make any payment after the death of the recipient spouse, and the payment is not treated as child support. Speaking of child support, most of the time when I see income transferring from one spouse to another following a divorce, it is child support. I sometimes see alimony in the state of Oregon, but it's pretty rare. Other states that might be more common, for example, California goes out of its way to say that spousal support is more frequently awarded in that state and to be on the lookout for items defined as spousal support because those are alimony. Some states it's more rare. So here in Oregon, I rarely actually come across true alimony. I'm usually looking at child support. So you need to be on the lookout for when someone is trying to claim a deduction for child support and calling it alimony, or maybe someone's receiving child support and wonders if it's taxable. Then it boils down to, is the payment child support or is it alimony? Now, a payment is specifically designated as child support to the extent that the child support or the payment is reduced either by a happening of a contingency relating to the child, such as the child becomes employed, dies, leaves the household, leaves school, marries, or reaches a specified income level or age, or at a time that can be clearly associated with a contingency. So, for example, if the child is going to turn 18 on June 30th, 2014, the alimony miraculously stops on that child's 18th birthday, then you can associate that as a contingency relating to the child because it coincides with that child's birthday. But if the alimony ends on December 31st, 2014, and it doesn't really tie into the age of the child in any way, then it would be safe to say that it probably would not be child support. But let's look at an example where we have a payment that is alimony. Steve and Sandra Ballard are divorced. Sandra has custody of the two children, and the divorce decree states that Steve shall pay Sandra $1,500 per month. The decree does not stipulate that any of the payment is contingent on either of the children, and therefore the entire payment is considered to be alimony. Here is where a payment is partially alimony and partially child support. Jean's divorce decree states that her former husband, Harry, must pay her the following monthly amounts: $600 social support and $200 child support for each of their two children. Harry made all required payments during the year. Jean must report $7,200 of spousal support as alimony income on line 7 of her tax return, and Harry, in turn, will be allowed to claim $7,200 as a deduction on his tax return. But the $4,800 of child support is not income to Jean, nor is it deductible to Harry. Now, child support is always considered to be paid before alimony. So if, a certain amount is due each year combined for alimony and child support, but payments fall short, then all payment is applied to child support, and anything in excess of the child support for the year then would become alimony. And here is an example. John and Jane are divorced. Their divorce decree states that John must pay Jane $13,200 each year based on the following monthly amounts: $600 alimony and $500 child support. During the year, John falls behind on his payments, and his payments to Jane totaled only $8,000 for the year, instead of the required $13,200. Jane will report only $2,000 of alimony on her return, and the reason for that is that the first $6,000 she received is going to be applied to child support. So 500 times 12 months, $6,000 is child support out of $8,000. So the difference between those two numbers will be alimony. Now, on the next page here up at the top, I have a table that really summarizes the rules for alimony. If you meet these tests, then you have alimony. And if any of the following in this column apply, then you don't have alimony. But I'll leave you to read that on your own. The next item we're coming up on is unemployment compensation. That is reported on Form 1040, line 19. And generally, any unemployment benefits you receive are taxable on your federal return. If your unemployment benefits are taxable, the state paying you the benefits should issue you a Form 1099-G. It's actually the same type of document that the state will issue for taxable refunds. So both those types of income items are reported by the state on the same document, a Form 1099-G. If you repaid any of your unemployment during the year, so you received 2013 unemployment benefits and then you repaid them in 2014, you should subtract the amount that you repaid in 14 from any amount that you received in 14. But if the amount you received in 14 is less than the amount that you're repaying for 13, you're going to need to claim that on Schedule A. But if you do make a repayment in 14 for 13 unemployment, and you also received benefits in 14. So let me give you an example. During 2013, you received $10,000 of benefits, and it was deemed that you should only have received $7,000. And then in 2014, you received another $10,000 of benefits, but you had to repay $3,000 from the earlier year. Then what would happen is on the 1040 for 2014, you would report $7,000 net benefits received on line 19. And on the line next to line 19, you would enter the word repaid and $3,000. So even though your 1099-G for 2014 would show 10, you're going to report 7, and on the line next to where you wrote 7 on line 19, you would enter repaid $3,000. And here is an illustration of a Form 1099-G. I took the liberty of putting both unemployment compensation and taxable refund on the same 1099, but that would never happen. The state would issue one 1099 for each. But I just wanted you to see the 1099 and how those income items are reported. The line 18 shows taxable state refunds. Assuming you've done your due diligence to determine that the refund is in fact taxable, you would carry that taxable refund to line 10. And if you determine that the refund is partially non-taxable or not taxable at all, you would of course leave line 10 blank or enter a lesser number. And then the unemployment benefits received would carry down to line 19. The next line we're going to look at is the other income line. So we're moving on to line 21 now, this other income line. And on line 21, we pretty much write in a description of whatever income item we're reporting. The interesting thing about line 21 is it's also used to claim a few deductions. So you could have a positive or a negative number on line 21. And a first example of a line 21 income item is gambling winnings. You are required to report all of your gambling winnings, not your net winnings. So gambling winnings are reported in full on line 21, and if you have any offsetting gambling losses, those are claimed on Schedule A, not subject to the 2% limit. It's a rotten deal, though, the fact that you have to report all gambling winnings on line 21 and then itemize your deduction for the gambling losses, because, for example, you may not have enough to itemize, and so your losses don't get any offset at all. But the other nasty part about gambling winnings on the front page of the tax return is that they can cause your income to rise and therefore force you to phase out on other items that you might otherwise receive a tax benefit for. So, for example, a few years ago, we had a client come into our office who had won $20,000 playing Keno here in Oregon. And that $20,000 of wins forced 85% of her Social Security benefits to become taxable. And if she hadn't received those $20,000 of wins, then none of her Social Security benefits would have been taxable. And then when we went over to Schedule A, we were able to offset all $20,000 of gambling winnings with $20,000 of gambling losses. She had kind of a habit there. But the net effect was that her Social Security benefits became taxable when she had no net income from the gambling wins. So it's just something to be aware of, and it's kind of a rotten deal. Now, when you do gamble and you do win, it's possible you're going to receive a document called a W-2G. And the requirements for W-2G are that you will receive one if you have $1,200 or more in gambling winnings from bingo or slot, $1,500 more in proceeds from Keno, more than $5,000 in winnings from a buy-in poker tournament type wager thing, $600 or more in gambling winnings except winnings from bingo, Keno, slot machines, and poker tournaments, and the payout is at least 300 times the amount of the wager, or any other gambling winnings that are subject to federal income tax withholding. Of course, again, any losses you have are claimed on Schedule A to the extent of your wins. Any more information on this, you can look at page 202 of Pub 17. The next item we're going to look at is canceled debt. Now, canceled debt is usually taxable income to the person for whom the debt was canceled, and that canceled debt would be entered on line 21, and you would describe it as canceled debt. If you borrowed money and then that debt was canceled, you generally report the amount of canceled debt on your tax return, but not always. If you want to read more about canceled debt, the IRS has a publication on it, 4681, Canceled Debts, Foreclosures, Repossessions, and Abandonments. You can get detailed information on it there. Now, if you have canceled debt, the entity that canceled the debt should issue you a Form 1099-C. So if you were a borrower and your debt was canceled, you should be looking to receive this document. Now, there's actually a 1099-C and a 1099-A. And this year I started to see people coming in with both of them. It was interesting. I dealt with a couple of clients who had gone through home foreclosures and then short sales on their houses. So as a result, they were receiving these 1099 documents, and very often it's the case that these people who are going through these home foreclosures had two mortgages on their houses. They had the original acquisition debt, and then they also had this home equity debt. And what I'm seeing is when that home sale goes through, they're getting a 1099-C on the base amount of the debt, that being the home acquisition debt. But if they had a second loan on the house, very often they're getting a 1099-A. And the 1099-A is a rather interesting one because it's the bank acknowledging that they've abandoned the house and that this debt is outstanding on the house, but it isn't necessarily the case that the mortgage company has really canceled the debt yet. It could be that the mortgage company is still after them and could pursue them legally for the balance on this second mortgage. So the 1099-C really represents debt that the lender has canceled. When you get a 1099-C, you can basically say, okay, this debt is canceled. Is it going to be taxable? Now I have to do some calculations. When you receive a 1099-A, it's kind of a limbo. It could be that the lender is going to cancel the debt, but it hasn't done it yet. Or it could be that they've canceled the debt and they're not going to pursue them even though they haven't given them a 1099-C. Or it could be that they're still going to be pursuing the money and they haven't made up their mind. And how do I know this? Well, I called the lenders for both my clients, and one lender said, yeah, we're considering canceling it. It's in a department that's considering that right now. The other lender said, it's done. We're not pursuing them. There was no way for me to know. So I played it safe, and I treated both as canceled debt on the return for the year, but it's entirely possible my client is going to get another 1099-C next year for the same debt we treated as canceled this year. I didn't see any other way to work around the problem. Now, of course, for a number of years, we've been dealing with this slump in the housing market. And in 2007, under the Mortgage Debt Forgiveness Relief Act, a law came into place that allowed taxpayers to exclude from income qualified canceled debt on the sale or loss of their residences. And that law was intended to expire after 2009, but it was extended for 10, it was extended for 11, it was extended for 12, and it was finally extended all the way through 2014. But as we sit right now, unless we have another act come into play in 2015, the Mortgage Debt Relief Act has expired as of the end of 2014, unless we see some changes. But they keep on extending it, so it's probable they'll extend it again. Now, what that act does, or what the Mortgage Forgiveness Relief does, is it allows a person who received a 1099-C from a canceled debt on their principal residence to exclude that canceled debt from taxation subject to certain limits. If your client is able to exclude their debt from taxation, they do so by filing Form 982. Now, I should tell you that 982 applies more than just to home mortgage debt relief. It applies to all different types of debt relief that are deemed to be not taxable. So it could be that you have canceled debt and it's not home mortgage debt, but it's still not taxable for a variety of other reasons. And whatever those reasons are, you claim exclusion from reporting that debt as income by filing Form 982. But we're going to look at the home side of it first. In order to exclude debt on your home, it has to be qualified principal residence indebtedness, and it is defined as a mortgage that you took out to buy, build, or substantially improve your principal residence, and it must be secured by your personal residence. And the following types of debt secured by your principal residence are also qualifying debt. A refinance of qualified principal residence indebtedness is treated as qualified principal residence indebtedness, but only to the extent that it equals the old debt just before it was paid off. Also, any additional debt that you took out to substantially improve your home, in other words, home improvement loans, can qualify as principal residence indebtedness. Now, there is an ordering rule. If part of your mortgage loan is qualified debt and the other part is not qualifying debt, you can only exclude the debt that is qualifying. And here is an example of what we mean by that. Your principal residence is secured by a debt of $1 million, of which $800,000 is qualified principal residence indebtedness, and then your residence is sold for $700,000. So $300,000 of debt is discharged. Only $100,000 of the debt discharged can be excluded. $300,000 that was discharged minus the $200,000 that was non-qualified debt. Now, non-qualified debt is debt that was not used to acquire or improve the home. For example, you might take out an equity loan and use that money to send your kids to college or to buy cars. Nothing to do with the house itself. That would be non-qualified debt. Insolvency rules relating to canceled debt. Even if you don't qualify for relief from taxation on discharged indebtedness under the Mortgage Forgiveness Relief Act of 2007, you could still qualify to exclude foreign debt from your income if any of the following apply. Firstly, bankruptcy. Debts that are discharged through bankruptcy are not considered to be taxable income. Or insolvency. If you are insolvent when the debt is canceled, some or all of the canceled debt may be non-taxable to you. You are insolvent when your debts are more than the fair market value of your assets. Also, certain farm debt. Farmers who can show that they meet the definition of farmers who get canceled debt related to their farming can exclude that. Certain non-recourse loans. Gifts. If a canceled debt is really just a gift to you, then it's not income to you. And qualified real property debt, if you have a mortgage on property that you use for income production, you're going to actually reduce your basis in that property rather than treat it as income. But all of those exceptions to canceled debt taxation are reportable on Form 982. Now, with regards to determining insolvency, you are insolvent when your total debts exceed the fair market value of all of your assets. Your assets include everything you own, such as your car, house, furniture, and personal belongings, life insurance policies, and stocks or other investments, or your pension and other retirement accounts. So you're going to add up the quick sale value of everything you own and see if your assets are less than your debt, and if they are, then you are considered to be insolvent. And you can read more about insolvency by looking at the publication I mentioned earlier, as well as the instructions for Form 982. Speaking of 982, I have one here for you. And on line 1E, if we were taking a canceled debt for discharge of a qualified principal residence, we would on line 1E check the box. And then on line 2, we would enter the amount of discharged debt that is not taxable. And then on line 10B, we would enter the amount that we are reducing our basis in the home by. And that's pretty much all you have to do when you're claiming discharge of debt. Now, we promised to look at the foreign earned income exclusion today, so let's get down to that. If you are a U.S. citizen or a resident alien and you are working outside of the United States, and you can show that you are either a bona fide resident of a foreign country, or you meet the physical presence test for being outside of the United States for at least 330 days during a 365-day period, you can exclude from U.S. taxation a certain amount of your foreign earned wages. Also, self-employment income can be excluded this way. The maximum amount you can exclude each year is $99,200, but there is an additional amount that can be excludable in certain situations if your employer provides you with free housing, or if you're self-employed and you are paying for some housing. And there's some additional computations that go on if you're going to claim the foreign housing exclusion. But to keep it simple today, we're looking only at a calculation that factors in the base amount, $99,200. Now, how do you know if you qualify to claim the foreign earned income exclusion? Well, you have to meet certain requirements. And you have to meet all three of the following requirements. Number one, your tax home must be in a foreign country. You must have foreign earned income, and you must be either a U.S. citizen who is a bona fide resident of a foreign country or countries for an uninterrupted period that includes an entire tax year. An entire tax year would typically be January 1 through December 31. If you live in a country for an entire year uninterrupted, that country typically would become your tax home, and that could qualify you for the bona fide residence test. But if you can't show that you were in a country for an uninterrupted period that includes an entire year, then you move down to the physical presence test. And under the physical presence test, you have to actually show you were outside of the United States for a period of time of at least 330 days in a 365-day period. But they can straddle tax years and don't have to be all in the same year. Now, there really is no waiver of the minimum requirements to meet the foreign income exclusion rules, except where you are forced to move or leave a country because of war or civil unrest or similar adverse conditions. If you leave for any other reason, you're going to be out of luck. So who can claim the exclusion? Well, if you worked in a foreign country, you can qualify to exclude up to $99,200 of income if you meet either the bona fide residence test or the physical presence test. The bona fide residence test is simply saying you were a bona fide resident of that foreign nation for an uninterrupted period that included an entire tax year. For the physical presence test, you can show you were outside of the United States for 330 full days during a 365-day period. The days don't have to be successive. You can come and go. And in addition, you don't have to show that you were outside of the country on business. You could have been outside of the country for vacation or any other reason. But here is a table from IRS publications to show you what they mean when you are calculating the physical presence test. You can see that we have a 12-month period that starts in January of 2013 and ends in December of 2013. That could qualify you for the bona fide residence test. But it can also qualify you for the physical presence test if you arrive in the foreign nation in September of 2013 and stay there through August of 2014. You've got a 330-day out of 365-day period when you're straddling 2 years. And so for 2013, you would be able to exclude based on income earned in these months, or a formula using these months, and then in the next year you would be able to use these months. There is a flow chart that you can use to see if you qualify for the foreign earned income exclusion. It essentially applies the rules I've been explaining. So let's take a look at an illustration of how the foreign earned income exclusion works. And it basically takes and applies the physical presence test to a character named Ozzy Sunshine, who is a U.S. citizen and moved to Perth, Australia on June 30, 2014 to begin work on a 3-year contract at Down Under University as a professor. He had $50,000 of wage income that he earned here in the United States, and then another $50,000 that he earned when he went to Australia. Since Ozzy was outside of the U.S. for less than half a year, he is going to need to prorate his exclusion on the number of days he resided outside of the U.S. He's not going to meet the bona fide resident test for 2014. He can't. He just wasn't there a full year. But he can qualify under the physical presence test. But in order to qualify under the physical presence test, he's actually going to have to finish out those 330 days in a 365-day period. So that means he's really going to need to finish living there for that period of time. So he really won't be able to file his tax return before June 30, 2015. But once June 30, 2015 passes, he can show he's met the 330 out of 365 days, then he can file his return. So in figuring the foreign earned income exclusion for Ozzy, we start with the maximum amount that he could exclude if he had been outside of the United States for an entire year. That number is $99,200. We then determine the percentage of the exclusion that Ozzy can claim, the days of physical presence outside of the United States divided by the number of days in a full year. In his case, he was outside of the United States 184 days during the year. We're going to divide that by 365 days in the total year, and we get 50.4%. We then multiply the full year exclusion of $99,200 by 50.4%, and we get $49,997. That's the maximum amount he can exclude for the year. But his total wages for the year are $50,000, so he's going to be able to exclude slightly less than he's required to report. And the amount he excludes is going to be a negative number on line 21, and he's going to include all $50,000 of wages on line 7 of his tax return. So remember, his wages come from 2 sources, U.S.-based income and Australian-based income. $50,000 in the United States, $50,000 in Australia. We total those 2 numbers and enter them on line 7. Now, since some of the wages, in this case $50,000 of wages, came from a foreign employer, he's going to write FEC, $50,000 on line 7. FEC means foreign earned compensation, and that tells the IRS why his W-2s don't approach that number and why he's got a big bump up there. And then we move down to line 21, and on line 21 we enter 2555 negative $49,997 and subtract the income out. When we do that, we end up with taxable wages of $50,003. Now, this is not a fully wonderful deal for Ozzy. Although he is only going to be reporting and paying tax on $50,000 of wages, he's going to be taxed on $50,000 at the same rate as if he'd earned $100,000. And although I'm not going to be covering the computations that go into the tax liability that he has on this $50,000, in today's class, I will be covering the computation in detail in another class I have coming up in the next few weeks, which is called Tax Credits for Individuals, including the Foreign Tax Credit. And in that class, we look at computations where an individual can claim the foreign tax credit, where they do so in coinciding with claiming the foreign earned income exclusion, and all of the computations that go into tax, which can be very complex because there's worksheets, sometimes multiple worksheets that you have to figure out. Here is the 2555 itself, and we are saying that he is qualifying under the physical presence test. We show his date of residency and where he's qualifying for those 330 out of 365 days. We enter his foreign address, his foreign employer. Here in Part 3, we enter information relating to the days present in the United States, but this is days of presence following the date that he left the country. So all of the days he was physically present in the United States before he went to Australia, those are not part of what we enter here. But if he came back to the United States briefly during his period of absence, then any days he traveled to the United States during that 330-day period would be entered here. Now on line 13, you can see we start with the maximum foreign earned income exclusion for the year. On line 14, we enter the number of days. On line 15, we come up with 50.4%. Line 16 is $49,997, which is 50.4% of $99,200, and then ultimately we look at the actual foreign wage he received because the foreign exclusion cannot exceed the foreign wages. The limit will either be $49,997 or $50. The lower of those two numbers carries to line 18. Finally, there is a table on the next page showing all of the different types of taxable and non-taxable income that you might run across and which are really described in publication 17. These are items that typically not taxable, and in this column we have items that typically are taxable. Examples of non-taxable income items that you can basically say, oh, if you got that, it's not taxable, and know that in the back of your head, are things like welfare benefits, food stamps, workers' compensation, disaster relief grants, cash rebate on an item you buy from a manufacturer, mortgage assistance payments, campaign contributions that are actually spent for campaign purposes, casualty insurance and other reimbursements, child support payments, court awards and damages for personal injury or distress relating to such injury, energy conservation subsidies, foster care payments that you receive for the care of children under the age of 19 that are placed with you by a government agency or other tax-exempt agency, also difficulty of care payments that you receive for the care of 5 or fewer individuals under age 19, gifts and inheritances, Indian fishing rights, and I actually have a client who gets these Indian fishing rights, job interview expenses by a prospective employer, interest on qualified savings bonds that you redeem and then use to pay for qualified higher education expenses, sale of personal property that you sell at a loss, but the loss is not deductible, scholarships and fellowships used to pay for tuition fees and books, VA payments paid by the Department of Veterans Affairs, but don't confuse those with actual federal pension. Many, many years ago when I was a green beginner, I had a client hand me a 1099-R from the government and tell me that was his veterans pension. And I said, oh, veterans benefits, those aren't taxable. And then when I was reading instructions a few months later, I went, holy cow, I was wrong. His pension certainly is taxable, and I had to amend his return and own up to my error. So just beware, clients will come to you and say certain things, but the documents may say something else, and you need to know the difference. Utility rebates that reduce the purchase price of electricity furnished to you or to give you a non-refundable credit against the purchase price of electricity. And finally, money you borrow and are required to pay is not income. But items that are income and are taxable include Alaska permanent dividends, activity that is not for profit such as hobby income, alimony, bribes, court awards and damages for things like lost wages or profits, punitive damages, settlement of pension rights, patent or copyright infringement, breach of contract, back pay, or damages relating to emotional distress from civil rights violations. I see these civil rights violations ones come into our office regularly every tax season. We have at least one client that those apply to, and they're desperately hoping they're not taxable, but they are. However, if they are receiving payments for discrimination, Through a discrimination lawsuit, they can claim an above-the-line deduction for their legal expenses. Other taxable items include credit card insurance payments, jury pay, estate and trust income that is distributed to you and is reported on a K-1, rents received for use of personal property, net business income after expenses, fees for services you perform as a corporate director, foster care payments you receive from a government or tax-exempt child placement agency if you care for more than 5 individuals age 19 or older, difficulty of care payments you receive for the care of more than 10 qualified foster individuals under age 19 or for more than 5 who are age 19 or older, payments for maintaining space in your home to care for foster individuals, gambling winnings, lotteries and raffles, illegal income, prizes, awards, free tours, sale of personal property you sell at a profit, scholarships used to pay for room and board, strike and lockout benefits, and cancel debt other than by gift or bequest. All right, so that concludes the lecture portion of today's class. I did want to give you one classwork assignment and then review the answer key with you. And in our assignment here we have a character named Jackie Rhodes, who is a widow. Her husband Jonathan died in 2013 and she has not remarried. She has 2 children living with her whom she supports, her daughter Kathy Lee and her nephew Sammy. They lived with her all year and were members of her household. They all had the required health insurance premiums for the year. And Jackie was unemployed for 2 months and received a 1099-G from the state of Oregon. Money has been tight since her husband died, and Jackie used her credit card a lot. She called the bank, and they agreed to cancel her debt with them. So she received a 1099-C for the cancellation. She is not insolvent. Jackie is a teacher. She is also a server on the weekends at Alice's Bar and Grill. She did not report any tips to her employer and did not keep a tip record. Her tax documents are attached to prepare her federal return. So here we have unemployment compensation totaling $41.68, and we also have discharged debt in the amount of $83.55. Moving over to the W-2s, we have one W-2 for Alice's Bar and Grill showing $1,750 of wages paid and $1,275 of allocated tips. And then from the Board of Education, we have another W-2 for $42,000. So let's pull up her answer key and take a look at her finished return. And we begin on the Form 1040. On line 7, we enter Form 4137 and $1,275. That explains that we're adding the allocated tips or the taxable tips into her wage. And so the wage that she's going to be reporting is $45,025, even though box 1 of her combined W-2s adds up to a lower number. The qualifying widow box is checked, and that qualifies her for the widow status. We enter the year of her husband's death. And then we move on and talk about the dependents. We have Kathy Lee and Sammy. And if the child is a qualifying child for the child tax credit, we check the box. Both these children qualify. We move down the tax return. On line 19, we enter the unemployment compensation she received. On line 21, we enter the amount of canceled debt. Next to that, we entered Form 1099-C. You could also just type in canceled debt. Either is correct. On page 2 of the Form 1040, we're figuring her tax using the tax tables after we claim her appropriate deductions. She's claiming a $2,000 child tax credit. And then on line 58, we're going to check box 4137 and enter $97 on line 58. That is the amount of tip tax she owes. We add the tip tax into her other tax, look at the withholdings. The withholdings are slightly low, and so she owes $81. But let's move on to Form 4137. On Form 4137, we show the total cash tips she received. Cash tips she reported to her employer was 0. She owes tax on all tips received. We're going to do the calculation down here. 6.2% of $1,275 is $79, and 1.45% of $1,275 is $18. You add those up and you get $97. So that concludes today's class on wages, tips, other income, and all of those exciting items. Thank you for participating. Those of you who are here as webcast students, go ahead and let me know if you have any questions. And other than that, I'll see you next time. Thanks for participating, and bye-bye. Army Bay, A-R-M-Y-B-A-Y, Army Bay. We hope you've enjoyed this tax education class. Pacific Northwest Tax School is approved as a CE provider by the IRS and the states of Oregon, New York, and Texas. We have been awarded the Quality Assurance Standard by NASBA and meet the CE requirements for CPAs in most U.S. states and territories. Tax clients demand knowledge and experience. Pacific Northwest Tax School provides the in-depth, practical education needed to improve your understanding of tax law and to meet the demands of the competitive tax preparation industry.